Hi, welcome to Closing Trades right here on ET Now, and what a solid rebound in place. Just how you want to finish off the week, and a tumultuous one at that. Closing in with almost a 2% gain and a 500-point move on the Nifty, no less. What's contributing to today's move, you ask? Pretty much everything. Even the Adani names have actually rebounded, and now they're breaking into the green. It's not so much about an HDFC Bank or an Axis Bank today. It's more the beaten down SBI kind of names, which were down about almost 4.5% at the lows of yesterday. 4.5% of an uptick coming in. You are, of course, seeing a continuation of the move on IT, the most resilient of the sectors in the current market weakness. TCS is gaining ground by about almost 3.6%. There's, of course, HCL Technologies holding out very well. Infosys looking very good. And then, of course, look at the move on some of the heavyweights. Look at L&T. That's holding up a good 3.5% right now. Reliance has moved up from its 52-week lows. Finally, a 3% jump coming in. Bharti's moved up. Asian Paints, BEL. I'm going to be very curious to see what the FI figure is and whether today also is a sell or not. But who better than to answer some of the questions on the emerging markets? We have none other than Sunil Kaul, a global emerging market equity strategist at Goldman Sachs, joining in the show right now. Sunil, hi, afternoon. Good to have you today on ET Now. And I guess the question on everyone's mind, when will the FIIs and FPIs stop selling India? Because while we didn't really care about that the last year and a half, right now it surely matters.
Yeah, I'm glad to be back. Look, before we sort of answer it's always difficult to predict when the flows will come back. But I think just to set the stage here, I would say, in general, the fact remains that if you look at what has happened in the global environment over the past month or so, especially after the U.S. elections, the macro environment has become much more challenging for equity markets or emerging markets in general, including, I think, India. So it's important to keep that in mind before we think about when the flows will come back. Because if we are looking at an environment where your dollar is likely to be stronger once the Trump administration comes in, obviously it started moving before the US elections, and those trends have continued to assert in that direction. So you're likely to see stronger dollar in the near term over the next 3 to 6 months. You're likely to see sort of more trade tensions between US and China. You're more likely to see rate cuts being pushed out because of concerns around sort of stronger growth and higher inflation in US. And sort of that environment in general is not great for sort of flows. And so we are not baking in a large amount of foreign inflows into the next 3 to 6 months into the emerging markets in general, including in India. So I think that the broader point I would make here is that the liquidity environment or the flow environment for the emerging markets, including India, is probably going to be tougher because you're not getting as much help from the external environment, and so you're much more relying on your domestic growth story. And there, I think what we would need is a stabilization on the earnings fundamentals. I think that would be critical for foreign flows to come back.
And that's exactly the point, right, Sunil? Looking at the second quarter and how it's really panned out pretty much across the spectrum, does it really feel that the growth story has gotten challenged, or do you think it's just a one-off quarter aberration that we saw?
Look, I think we had been seeing a slowdown in growth across pockets for a few months already, right? And so we actually did lower our view on India. I mean, we like the longer term structural story for India. We have been overweight the market for a while. We actually lowered it from overweight to neutral a month back, and so the timing was decent there. And I think the real reason, obviously, was that growth had been slowing down for a few months already, sort of 4 or 5 months now, across pockets, right? So we had sort of government cutting back on spending, and so the infra sector was seeing a slowdown. Obviously, consumption, we have been seeing slowdown for a while, and so our sense was that as we start to head into the earnings season, you should start to see numbers coming under pressure, which is what has already played out. I think our sense is that, look, I think the downgrade cycle is not over yet. If you look at next year, the street is still expecting around 16% earnings growth in calendar 2025. We have a below consensus view both on GDP growth, where we are at 6.3%, but also on earnings growth, where we are at 13% versus 16 from consensus, so we are 3 percentage points below. So we think that there is still one, possibly 2 quarters of downgrade still left there. We do think that if you think about this slowdown, just to be careful, we do think it's not a structural slowdown. It's a cyclical slowdown that was caused by multiple factors, partly sort of fiscal consolidation by the government, partly because of the slowdown we have seen in the consumption, sort of mass market consumption, partly because of the macro-prudential measures that RBI had taken almost a year back on the retail credit side, and partly obviously because of the tighter sort of liquidity that RBI has kept. So all of that has actually led to the slowdown, which we think you can think about that as India sort of slowing from above trend to kind of going back to trend growth. And so we think things will start to turn much better towards the latter half of next year calendar, so towards the mid of next year, when you would start to see some rate cuts from RBI. You would start to see that the credit cycle, the retail credit cycle, we think will be sort of stabilizing by that time. Fiscal will still remain a drag because the government will continues to consolidate there. But in general, I think both the consumption cycle as well as the monetary policy cycle will start to become much more supportive. So we are sort of much more positive on the market towards the latter half of the year, because that's when we think that the cycle stabilizes.
Your Nifty target for 2025 is quite a big one. It is certainly higher than what it currently is, which means that you expect that 2025 could be a double-digit return year for the Nifty?
Yeah, I mean, we just to sort of set the expectations here. So we have a 24,000 target for the March 2025, which is sort of roughly 4 months from now, which is flat market. So we do have a view that over the next 3 to 4 months, the market will be sort of more range bound, sort of more a time correction in here. But then, as I said, as we sort of get deeper into the year, we do think that the earnings will start to recover, and so our sort of calculation here is that you basically see roughly a mid-teen earnings trajectory, 13% for calendar 2025, and a little bit higher in 2026. So so the market will sort of grind on the back of underlying earnings to a sort of double-digit 12-13% return, 13% return for the full year. So clearly, we have a 27,000 target for on the end of 2025. That's sort of double-digit upside from here on, but it'll be much more backloaded on the back of earnings recovery, is our sense. So we do have a flattish target over the next 3 months.
The markets moves ahead of actual events, right? So if earnings are going to be, let's say, back-ended for calendar year 2025, markets should move ahead of it. I mean, I'm just putting the historical logic here.
Yeah, of course. That's always the case. The markets are forward-looking. I think what we need to think here is that when will be the time when, I mean, it's always tricky to time markets, to be honest, Nikunj, but I think what we are sort of thinking of is that you want to get to a place wherein your global headwinds also start to moderate and your domestic is starting to sort of pick up, right? So if you sort of look at when we think that would happen, we do think that bulk of the macro pain, so to speak, in terms of stronger dollar rates higher for longer, and potentially more trade tensions will be front-loaded in the administration. And so we have a sort of 3 to 6 months steeper trajectory on those things, and then things are kind of stabilizing in the second half of the year. So I think as we get, as I said, as we get sort of deeper into the year, probably sort of more towards the June quarter, we still think that December quarter earnings are going to be softer. Probably you start to see things recovering in the March quarter, and so I think that's the time when you start to see stabilization in the earnings trends, as well as sort of macro starting to get a little bit better, which could be a decent point to re-engage in the market. Obviously, I think from now until then, if the market does from current levels, there will always be sort of buyers on those dips. But I think in our base case expectations, we think it would be much more towards sort of the second to third quarter when market starts to do much better.
Right. Sunil, so where is it that you see meaningful earnings growth? Given that you think that this is just a cyclical problem and not a structural one, what sectors are you going to lead the recovery?
Yeah, so I think even within the way we sort of think about sort of sector allocation is that, over the last year or more, we had been mostly focused on domestic sectors, and that's where bulk of the earnings was also coming through. We also saw most of the previous quarters, actually, numbers where whatever the street expectation and our expectation was, numbers were coming in ahead of expectations, and that's where earnings were getting upgraded. What we have done this year is we have made a more, for next year, in terms of our outlook, we have made a more balanced allocation to sectors. And so we have upgraded the export-oriented sectors like IT from being market weight earlier to overweight, and then pharma from being underweight to market weight. And so in terms of the earnings pool as well as the allocation wise, we do think that within the domestic sectors, it would largely come in from the sectors where there is decent earnings visibility. So that would include things like autos, include things like telcos. Financials will also have a little bit of, it's a large part of the market, so they will also contribute decently to the earnings, but it will be sort of domestic sectors like autos, real estate, telcos, and then IT will also start to do much better in terms of its contribution. So those would be the key leaders in terms of what will drive the earnings growth of 13% forecast for next year.
Centered around the fact that you expect earnings recovery. So if earnings recovery is round the corner, what is that catalyst which will drive earnings recovery? Could it be domestic consumption? Could it be government spending? Could it be export recovery? Where will the catalyst come from? Because the quarter gone by was not very inspiring. We got hit on capex, we got hit on demand, we got hit in terms of both discretionary and non-discretionary spend.
Right. Yeah. So I think in terms of our own forecast, Nikunj, as I said, look, if you sort of split into those three big buckets, as you just mentioned, export is unlikely to be very strong sort of catalyst for next year, given the global environment we're talking about. I think having said that, I would still note that if you look at India's equity markets compared to many other pockets of the world, only 6% of the MSCI India revenues are go to US. I mean, sort of sales into the US. Out of that 6%, actually 4% is services revenues, largely from the IT companies. So the goods revenues is only 2% of the MSCI India, which is much lower than 15 to 25% you see in Korea, Taiwan, and other places. So the point being, I think even from the trade wars and global sort of tensions around exports, Indian equities and economy will be less impacted, but it's fair to assume that trade or exports will not be the boost to growth in here. Then you sort of are relying on both sort of investments and consumption. On the investment side, obviously private capex, we haven't still seen it being broad-based. There are sort of pockets where private capex has come back, but it's still not broad-based, and it's unlikely that it improves meaningfully in the next 3 to 6 months, given the political environment overseas. But on the government side, again, they have been sort of fiscally consolidating. There was an underspending this year because of elections. So just because of that, there will be a little bit of pickup in spending over the next 6 months. But we would be fading that, because once you start again next year, post the budget, government will likely be again sticking to fiscal consolidation. And so fiscal will still be a drag. So where we think recovery will happen is from two places. I think one, as I said, the drag on the consumption and the latest data points, by the way, for the month of October, started to see some pickup in sort of two-wheeler sales and some of the consumption data points. But our sense is that a lot of the drag you are getting from retail credit because of the RBI measures, and we already see that impact in the loan growth numbers, in which loan growth went from the retail loan growth went from credit growth went from sort of 20-25% to sort of 11% now. So we're already seeing it going through the system for almost a year now. So we think that will start to stabilize and recover there. And so you should start to see that in the volume growth recovery for some of the consumer names as well, and also in the credit growth numbers for the banks. So I think consumption will start to recover. And then I think the RBI rate cuts and sort of liquidity getting to sort of a surplus at the margin should also ease things. And then obviously there are sectors where earnings visibility has been decent, and so they will continue to juggle along. I think all of that will mean at least the trajectory for earnings will start to stabilize and improve. Because right now, I think what's happened over the last 1 month in the BSE 200 is almost 7 out of 10 stocks are seeing earnings downgrades. And for example, if you look at things like earnings sentiment indicators, which look at upgrades less downgrades, they're at a 2-year low in the recent reporting season. So things have sort of our earnings have come under pressure, but I think that the second derivative of that will start to improve as we go deeper into next year.
I have one more question, which is that every 12-18 months there are some trends within trends which are at play. For example, I'm just expanding this question, Sunil, for the benefit of our viewers so that they can relate with it. This year it's been all about quick commerce. Last year it was all about financial inclusion and brokerages and NBFCs and AMCs. Another big theme right now is solar and energy transition. So for 2025, what are these mini cohorts or trend within trends which you see could outperform for 2025?
Look, I think, as I said, the good place would be sort of looking at what pockets we are sort of overweight on and what are the themes we are liking. So I think out of the different cohorts, for example, real estate continues to be, in terms of the cycle, real estate continues to be one where the cycle remains strong, and so the demand in terms of both resi and then commercial is still decent. So we like pockets of real estate, playing the pockets of real estate through the sort of the late cycle building materials, for example, so the pipes and ceramics and all of that. So I think that segment will remain strong. The high end consumption has held up pretty well, so I think we continue to like that space. I think the thing with India, and I'll sort of get into that, but I think even though the broader message on a beta perspective over the next 3 to 6 months is constrained, we do think there is beneath the head index there are enough pockets where people can continue to be engaged. And so in consumption, it remains high-end consumption. Mass market will remain under pressure in the near term. But for example, we are seeing signs of rural recovery already, whether it's two-wheeler data, but other data points. So for example, agri as a theme, and the government has been focused on this as well. So agri as a theme in terms of sort of supply chain related companies, agri infrastructure related companies, sort of cooling, those sort of fertilizers, that sort of falls into that bucket as well. So we have a group of companies we track which are linked to the broader agri theme. So I think that could continue to improve, especially if the rural recovery becomes more visible. So I think that will be the consumption pocket. I think the EVs, we like the longer term story around sort of EVs and the energy transition. Obviously India is, like other sort of economies, is trying to be sort of self-sufficient on energy. When it comes to equity market, it's a little challenged because some of those names have done fairly well. And so we are sort of more neutral that camp because of the valuation concerns. But as a structural theme, we still think a clean energy makes sense. Tourism is another theme which hasn't seen as much slowdown, to be honest. So I think we still like pockets there. And I would say, So I think those are some of the pockets where there could still be opportunities.
Well, Sunil, really appreciate your time, and I'm so glad that you could join us today, especially on a day when looks like we are in for a good turn. When was the last time we saw 500-point recovery on the Nifty? You take out your glasses and say, okay, touch wood, guys, touch wood. 500 points on the Nifty does not happen on a daily basis. I mean, this is the kind of recovery what we saw, let's say, in May, on that election verdict when markets came down and then it actually recovered. Take the clock back, please. Take the clock back. Let's go back to May on the Nifty. Let's take it back. Stretch it by 5 months. Take it 5 months back. And what do we have? I shall see 22,000. Let me use that as a round number. You have not gone below the election low, and you bounce back ahead of the election low. So I mean, with so much of news which has been thrown at us, and with that big disappointment which came on the election day in terms of what the market positioning was, 22,000 is intact, and which is where this market has found support again. So just a mathematical number, I think.
We're still higher than that number.
Exactly. And I think the news and the environment is much more noisier than what it was, at least on that day.
Absolutely. And not just India, but globally as well. So we're staying put quite okay. And of course, it's technology all the way, which is leading the gains today. Of course, there's other heavyweights like SBI, ITC, Reliance, L&T, which are all powering ahead and contributing to the Nifty move today. But we'll track all of that after this very quick break.
All right, now in conversation with, not in conversation, I have to welcome Kunal and Naresh. Hello. You are here and markets are up. Let's make this as a habit. Whatever, let's do whatever it takes for markets to go higher.
Hopefully so.
Aisha was wearing green in the morning rooting for the Bulls.
Well, I'd forgotten about what Bulls look like, but yeah.
How should one read into this monster comeback? Is it a one-day wonder, or when you see this kind of a comeback with so much of force and gusto, it will turn things for the Bulls? Is it an impressive one? Is it a turn moment for the markets?
So clearly an impressive one. If you look at the last 4 days of price action has been covered with a single candle, with a single move. Now, if you look at 23,300, 600, we are at 23,900 plus in a jiffy. So overall, that's a positive move. And next we go towards the fact that Bank Nifty is breaking out above a swing high. You have Nifty IT index taking leadership. It's actually getting closer to a new 52-week high and all-time high. So overall, now all we need is a Reliance to pull back and the whole heavyweight basket starts trending up.
Yeah, absolutely. Kunal, meaningful as it may be, but does it look like it's a durable move today?
Yeah, it looks like, because it's led purely by large cap names. You know, when is the last time we'd seen all Nifty 50 stocks in the green? At least in the last 37 trading sessions, we've forgotten that. So I think it's been a very strong comeback for the index. We've broken past about a series of resistances on the way up, 23,500, 23,750, and that too on just about a single day of price uptake. So that itself, I think, is a sign of strength for the index coming back. Now, what should ideally happen is that in case if the index say gets into a bit of a consolidation at higher ends, say 24,000 now becomes a pivot for the index over the next couple of days, then we could be looking at the market breadth improving quite significantly. So I think now the next set of trade, for the next couple of days should be try and focus more on the market breadth, and especially on the mid cap and the small cap front.
Okay. Now it's a powerful rally, but there's nothing 100%. So Monday morning, what are the levels? What is the kind of follow-up buying? It is important for us to assume that the worst is behind us. It could be a one-day wonder, right? I mean, what's looking like a good Friday, it could turn out to be terrible or a poor Monday. And we've seen that happen. For example, last Tuesday, we went all home assuming that markets had bottomed out. Wednesday was a market off. Thursday markets came down. Friday we are celebrating.
And remember, tomorrow is the election verdict. It may not be too much of a market moving event, but sentimental impact for sure.
And if exit polls are anything to go by, looks like it's the ruling party.
They've always
which
got
will
it
come
wrong,
back,
at least in the past. Yeah.
So what is that level which you would say needs to cross, or markets now really need, or Nifty really needs to cling on to get convinced that this is a durable and a sustainable rally?
See, I think what typically happens is, Nikunj, we are now very close to 24,000 mark. We are heading to the expiry week, which is the next week for the indices, both the Nifty and the Bank Nifty. And from here on, you would probably see now the Bank Nifty going into a monthly series. Now, when you see such kind of a scenario, when the index comes very close towards a strong psychological mark, 24,000 mark, we typically expect that the index breaks those levels. Now, my expectation is that we should see a follow-through up move. If not on Monday, then at least over the next 2 or 3 days, going into that 24,000 mark, which means that we are now looking at the next pivot range for the index just around that 24,000 level. So we could be looking at, say, 200 to 50 points as a swing, plus minus 24,000 mark for the next 1 week or so. My expectation is that we should see a follow-through up move for the index over the next 2-3 days.
Okay. The other important story today is come back in Adani group of companies. I mean, same time yesterday, they all were just beaten black and blue. The floor was knocked off. Everybody, irrespective of the core fundamentals of Adani group of stocks, they were just getting treated in the same manner. From ACC to Ambuja, from Adani Enterprises to Adani Green, everything just got knocked off. But is it a good time to buy them? What about core fundamentals? There is an allegation of a bribery case by an US court. Should markets really bother about it? Can we ignore? And should this decline be used for market participants to really add to their long-term portfolio? Nishal Meshwari, connect the dots for us. Adani stocks were down yesterday, 15 to 20% on an average. Today they are bouncing back. While they have not recovered whatever they lost yesterday, at least the falling has stalled today.
Hi Nikunj, thanks for having me. I think this is more of I'm saying a knee-jerk reaction basically, where the market is sort of a short covering. I think all the Adani stocks have also recovered on the back of that. As far as fundamentals, I don't think so anything has changed for Adani group stocks. I think as far as cash flows, businesses, all seems to be pretty good. The only thing remains to be, obviously, is the, I wouldn't say conviction, but the ruling which has come into the US courts against Adani. I think that is a sign of caution. What kind of impact it will have, basically, it is still in a very early stage because the trials have yet not started. So don't know basically which way it will go. So I think it is best to avoid these stocks for the moment and wait for a more clearer outcome before entering into these stocks.
Listen, what we saw yesterday was that, all the banks with exposure to the Adani Group, they were the ones which are really getting hammered. But do you think the Adani Group per se has enough headroom with Indian banks for growth capital, and that was perhaps just a knee-jerk and more sentimental reaction?
I do agree with you, Aisha, on that, basically, because I do not think that Adani's, the whole business part of it basically is rock solid. So there is no issues about cash flows and all that kind of stuff. Yeah, the growth may be a bit hampered. Maybe they will not be able to raise the same kind of money which they were able to do it earlier in the international markets. But otherwise, I think the businesses are pretty solid on the ground here. So I think the banks was more of a knee-jerk reaction because they have some exposure to the Adani Group. Otherwise, bank doesn't seem to be having any issues per se. But yes, yesterday could have been a good time to actually accumulate all these banks.
Nishal, markets have a very ugly memory of how Adani Group of stocks reacted when this entire, Hindenburg fiasco broke out a couple of years ago. Then the first reaction was more like a knee-jerk reaction, like you said, how stocks fell yesterday. Do you think we cannot compare what happened 3 years ago because of the Hindenburg episode versus what is happening now? Those are two completely different, unrelated and not correlated things.
So I don't think so there's any correlation per se in between, because what Hindenburg had said that the issue about the businesses and all, I don't think so. That is because after 3 years also, all those companies are, I'm saying, standing there, cash flows are very strong. Now, this is something else altogether which has come out. And this, I would say, put more credence to this rather than the Hindenburg report, because this is in a court of law and trials will happen, all that. But I'm still saying basically, as far as businesses are concerned, as far as cash flows are concerned, companies concerned, I don't think so that is much of a worry. The issue about, corporate governance and all that, I think that is one part basically which will get maybe, which will have some worries. But as far as businesses are concerned, I don't think much has changed.
Entire concern, Nishal, which at least a cross-section of market participants which they had, which was that, okay, what will happen to their debt issue now that they have cancelled their fundraising in a dollar-denominated bond? Do you think we should ignore that? Because irrespective of whether they go ahead with the near-term bond raising or not, the cash flows and the debt levels are pretty manageable?
So I do not track each of these companies individually to really say that they are very comfortable. But what I've looked at historically, I think they are fairly cash flow. I'm saying cash flows are pretty solid basically for the Adani Group. Maybe what will get hampered is their future growth. But existing businesses, I think there is no issues per se. We have seen after the last Hindenburg report also 3 years, I was telling you earlier, because none of these companies have had any issues about the cash flow part. So do not see more problems there. What I would be worried about is if this was the issue basically regarding future growth, that might get delayed a bit.
Okay. All right, Nishal, appreciate your time. Thank you for joining us. Shrad's going to give us more granular details now in terms of where the group positioning was 3 years ago versus now, and how things, at least on all parameters, growth, cash flow, debt to equity ratio, even market cap and new institutional investors, things have only improved for them.
Well, yes, if you look at it, the important operational parametrics Adani Group has improved. Overall, yes, the debt levels have increased if you look at it on a 3-year basis. But an important parameter to track is the EBITDA numbers also. They have also significantly improved. So the metric which we are using is the debt to EBITDA metrics, and that has actually considerably reduced. Now, in our analysis, of course, Ambuja Cement itself is largely debt-free. And also, Adani Wilmar was listed in 2022. Now, let's look at how the market cap changes have actually come across over the last 3 years. Key companies such as Adani Enterprises, Adani Ports,
they have actually jumped, ranging between 36 to 64% in terms of market cap addition. And even Ambuja Cement, if you look at it, that has given a significant jump to the almost 55% returns to the shareholders. A couple of companies did fall in their market cap, but overall the market cap on a group level has remained steady. Now also the debt to EBITDA numbers, if you look at it, these numbers have actually improved. We have taken the numbers from FY22 and then we have compared that with the last 12 months EBITDA number on a trailing basis. And over here, Adani Enterprises, Adani Ports, Adani Green, Adani Energy, all these four main companies, they have actually reduced, or you can say even halved this ratio. Interestingly, Adani Total and Adani Wilmar also, if you look at it, they have also reduced, but not significantly, but to the range of say 15 to 25% odd. So the main parameter to look at it, the debt to EBITDA numbers, they have actually significantly reduced over the last 3 years itself, and signifying a very strong up move when it comes to the operational profit coming to the Adani Group companies.
Right. Okay, Sharad, we'll leave it at that. That's the Adani Group, well on its way to recovery, as is the rest of the market too. We'll take a very quick break, come right back. We'll track the last few minutes of trade this week. Back with closing trades right here on ET Now. The recovery stays put. We're up a good over 500 points in the Nifty alone. SBI, TCS, there's L&T, HCL Technologies, Bajaj Finance, ITC. It's largely technology as a sector, and of course, it's the heavyweights like SBI, ITC, Reliance, L&T, which are giving the Nifty that much required leg up. In fact, it's difficult to actually spot any losers today. There's Bajaj Auto, which is flat. There's Federal Bank, but again, remember, Federal Bank is also one of the few stocks which is sitting at its 52-week high, and it's managed to actually gain ground in the market weakness of the last 2 months. Federal Bank is flat. Idea is the one which is down about 3% or so, and maybe MFSL, PI Industries. These are some dots of red that you can just spot should you wish. But Devang Mehta is well on the show with us. Devang, what is the market pricing in? Does it seem like there is a durable bottom in place?
Good afternoon, Aisha. I think this is actually the price one pays while we try to time the market. And honestly, this is more the time you spend in the market, getting in and getting out is more fashionable. But I think when you miss out on such days, the return drastically suffers over the longer term. Yes. I think probably what market was actually oversold, not on a technical basis. I'm not a technical analyst, but I think on the fundamental side also, the price correction, the valuation correction that the market went through on the index level. Of course, the large cap was more than 10%, mid cap around 9%, small cap around 8%. But if you look at the businesses of the stocks, they were correcting by 10, 15, 20, 25, 30, and even more than that. So I think there was earlier there was gravity and now there is a bounce. Probably I think market has started to factor in that this quarter earnings are now off the shelf. The next couple of quarters, I think there'll be an improvement in one, government spending. Second, we also know the consumption on the bottom of the pyramid in the rural areas also seem to start to come back. I think in the next 6 months, we'll start a marked improvement plus a lot of money flying back to US. I think those markets will also start to look a bit expensive and we will start to look at least one standard deviation below or at least very close to the fair valuations that we are reaching after a long time. I think one needs to, I'm not saying that the bottom is in place, but maybe 2-5% here or there, but probably from here on one needs to be more constructive than sort of not being so positive.
Okay, Devang, unfortunately got to wrap up the market for the day and the week. But thanks for taking that time out for a quick comment. Kunal, just one top trade for the day, or actually for Monday now?
So I'll go with the barn. TCS looks very attractive at current levels for a potential target of at least 4350, 4400. Stop loss to be kept at 4160.
Naresh, any top idea?
So that would be a buy on Axis Bank, which has not moved up much. Stop loss at 1125, target price of 1170 plus.
Okay, and with that, I'm going to hand it over to Snehi as well to wrap up the closing trades, which are finally some bullish moves, Snehi.
Absolutely, Aisha, what a way to sum up today's trade. It's been a good Friday for us indeed. Because if you take a look at Nifty, finally, all we're seeing is green on the screen. You have Nifty up to 2.2%, very big jump up coming in of 500 points. Intraday, we're closing above 23,870. very close to 23,900. So this exuberance is surprising, but well, yes, always happy to see. Sensex up 2.3% as well, very close to 79,000 on that front as well. Advance decline ratio very steeply in the favor of the advances today. You have the likes of SBI, Titan, TCS, Ultratech, ITC, Infosys, Tata Consumers. All of these Nifty gainers up more than 3%. However, Bajaj Auto is the only Nifty 50 constituent in the red. Seen some selling pressure today, 0.5% lower on that front. Very quickly taking you through some gainers and losers. Nifty Media is your only sectoral loser on the index front. Other than that, you have IT, top sectoral gainer, more than 3% gain coming in. Realty continues its positive run, coming in at number 2, followed by PSU banks, FMCG, energy, auto, metal, bank and pharma in that pecking order. All in all, it's been a phenomenal day for us on the street on the back of some much needed cheer that we needed. The markets have been up since morning. It's a one-way advance coming in for the Nifty today. India week's looking good, looking manageable as of now. So overall, it's been a very good day. Broader markets have underperformed the benchmarks, but nonetheless, the benchmarks have held really smartly today. 2.2% higher on the Nifty is how we're shutting shop for the day.